Welcome to Markets Now. I'm Michelle Rook with Shawn Hackett with Hackett Financial Advisors. Pretty much everything up on Friday with the exception of the wheat market. And Shawn, I want to start off talking about soybeans. We had a pretty good rally there. Of course, was it new contract highs in the soybean meal market, or was it all this talk of China business again?
I think it's a little bit of both. I mean, obviously, we know the soy market loves to follow the meal market higher. It always has in the past. We love to see China's business. Obviously, with Brazil being such a competitor nowadays, it's harder to come by. But whenever we can get it, we're excited to get it. The market sold off hard after that attempted rally from a week ago. We're getting ready for a USDA report here in another week or two, and I just think this was a reason to bring some short covering back into the marketplace. Maybe they got a little carried away with a market that's still on the balance sheet. Looks very, very tight here, at least in the U.S.
Yeah, it does. But yet we can't see this market stay above the $13 mark. So is that just because of the risk aversion that we're seeing here in all of the commodity markets, or what?
No doubt that is a big part of why most commodities have not been able to break out to the upside from their trading ranges. But I also think that, the way Brazil has been growing soybean production the last few years, the worry is that, wait a few months, they're going to have another record crop and our export business is going to be over. Why should we put premium in here for the U.S.? That's what makes Brazilian weather prospects so important this year, because if we're correct that the northern half of Brazil is going to be looking at some higher order drought and we could have a crop well off last year's levels, that would really set a different tone to what the U.S. price needs to do as we enter our planting season here in the spring.
Yeah. And both, soybeans for sure, and corn even, have been in these really big trading or sideways trading ranges. Not big, they've actually been fairly narrow. So is it what you just mentioned, South American weather? Is that the only thing that will get us out of those trading ranges, or would a demand push also help?
I mean, the three things I can see that would do it: you'd have to have a dramatic reversal in the U.S. dollar, which would probably be stimulated by an escalation of geopolitics or a big change in the Federal Reserve policy. Obviously, weather, which we just discussed. The other thing that I could foresee is somehow the USDA surprises to the downside and really comes in with substantially smaller crops than what the market is currently expecting, which is not much of a change. Those would be the only three things I could see that would really allow the risk capital to want to chase the grain markets beyond the tradable rallies we've seen over the last month.
Yeah. Corn market today looked like it was trying to follow soybeans, but kind of got held back by the wheat market.
Yeah, wheat and corn have this symbiotic relationship. They're not perfectly tied together, but they are very much tied together. And I just think very, very hard without any real news, in front and center to drive the corn market, that when the wheat's under pressure, it just saps any buying interest that you have in the corn market during that particular day that happens.
Yeah. What else is the corn market trading right now? I mean, we got above $5 when there was rumors of China business. When it wasn't confirmed, the market went back the other direction. What direction or what news is the corn market looking for right now?
Well, given that the USDA says we're going to have 2.2 billion bushels of carryout, the market's not really too worried about short-term supplies, obviously. So long as Brazil has this big crop from last year, anytime that we become uncompetitive with them, they're going to get the business. So I think we're kind of right now trapped between adequate U.S. stocks, large supplies that still are available for sale in Brazil, and we're not close enough to worrying about weather in the northern Brazil for second crop corn yet. So I think we're just stuck in this very tight range where the market is comfortable that the supply demand fundamentals are, support this trading range that we've been in.
What about yield? We hear so many farmers that say, hey, my yield for corn anyways came out way better than I expected. Do you think the market is bracing itself for maybe an increase in yield in the next WASDE report or not?
Well, we heard a lot of this talk before the last WASDE report that the yields were coming in better, and they didn't really corroborate that. What I keep hearing is incredible variability from farm to farm, one side of the road to the other, all over. I just don't think the USDA is going to make any big changes to what they've already put out there. It's going to take a long time for them to come up with test weights, enough data, enough statistics to suggest what the true yield is. I just don't think we're there. And a highly variable crop means we may not get the answer until the March or even the June quarterly grain stocks report, when they, make some big adjustments to some of the mistakes they made during the fall yield expectation season.
Yeah. And what about the wheat market? Down on Friday, down for the week once again here. It seems like that market can't get really any bullish news to drive it. Are we trading geopolitical headlines at all, or are we trading weather, or what's going on?
I just think we're trading the endless willingness of Russia to sell wheat cheap.
Okay.
At the end of the day, every market trades off of differentially on the Russian cash export price. And so long as they continue to feel that they have the supplies and the willingness to sell at a price that makes it very difficult for any prices anywhere else to get themselves, over the hump, we're just stuck. We are stuck in that zone until something changes with that dynamic. It will change. Nothing lasts forever, but we're not seeing any evidence yet that Russia is deciding to back away from being an aggressive seller of, their wheat supplies at this point.
You would think prices would be getting low enough here in the U.S. We would be seeing better demand, though, pretty soon.
We're seeing some better demand. We have been seeing some Chinese demand coming in that doesn't normally come in. So yeah, I would agree. We're now finally getting competitive with Russia and the rest, and so we should start to get some better business. But remember, that is predicated on staying cheap. The minute you rally and you become uncompetitive, you lose the business. So it's a catch-22. You want to move the product, but at the same time, it doesn't really necessarily stimulate a higher price until you move enough of that product.
Yeah. Let's also talk about the macro markets. We had GDP out this week. We had PCE out this morning. Really, this should signal that we're going to stay higher longer on interest rates. And so what? The macro climate's going to be pretty rough for a while, you think?
Yeah, these two economic numbers were just not, if you're a commodity person, it's just not what you wanted to see. It says growth was better than we thought. Inflation was worse than we thought to the upside. It says best case scenario, the Fed's on hold, but they might actually raise rates again before the end of the year. And with bond yields, having lost 50%, the bond prices have lost 50% from their highs from a few years ago. One of the worst 2-year bond market performances in the history of the U.S. Treasury market. That's the biggest market in the world, and the losses that have occurred in the Treasury market, Michelle, are just unbelievable. That does not support aggressive, highly leveraged risk capital wanting to chase risk assets, whether it's stocks, whether it's commodities, whether it's commercial real estate. It just keeps everyone wanting to keep tight on the vest on their money and only standing out if they see a real reason to come into a market. And as I said earlier, to me, at least for agriculture, for grains, I think Brazilian weather would definitely be what I'd be looking for to make that happen.
So this risk aversion, is that part of the pullback that we've seen here in this cattle market?
It is undoubtedly part of it. The cattle market does not like to see the stock market decline by 10%. The cattle market has been trained that if the stock market's going down, it's telling you that the market's worried about future economic activity, disposable income, and demand. When you get a cattle on feed report, which arguably, at least according to me, was one of the more bearish reports we've seen at least a year, and you had funds that were aggressively long that market, it was a recipe for a mass exodus, which is what we have now seen, although we did bounce today on what looks to me some kind of a oversold, maybe short covering rally that we might have here for a few days. But in the cattle market, I don't think we're going to get traction again unless the outside macro markets become more friendly again.
All right. Your bulls in the cattle market, they'll say, hey, cash improved as we went through the week. We've been able to shake off a lot of this outside market noise. Choice boxes are still above $300. Tight numbers. They'll give you all of these, I guess, answers of why we should still stay up here in terms of price. Do those fundamentals trump these other things that you just talked about?
I don't believe they do, and they haven't, because the market's down a lot despite what you just said. And remember, the market is supposed to look ahead. Cash numbers are today. The market loves to tell you what's going on today. Well, you needed to trade that 6 months ago. What I always try to do is what are we going to be talking about in 3 months and 6 months from now? And I don't think we're going to be talking about beef cutout prices at these higher levels. If this macro picture remains this negative, it's going to have an impact on buyers' decisions, in our opinion.
All right. Well, definitely something to keep an eye on. Thanks so much for joining us, Shawn Hackett with Hackett Financial Advisors. That's Markets Now.